Welcome back to another edition of Intended Consequences, the official podcast of the StrategyCorp Institute of Public Policy and Economy. I'm your host, Sebastian Lebrec. Uncertainty has been the theme of 2025, and the impacts are visible across the economy, including capital flows. When times are uncertain and it is hard to predict economic patterns, companies usually have a harder time accessing capital. This, in turn, can have impacts on their survival, operations, and growth. With the tariffs and Trump's announcements, the stock market has been seesawing dramatically. But this is only part of the story, as a lot of companies, especially the smaller ones, are not publicly listed. To get a better sense of the capital and funding landscape in Canada, we also got a look at the venture capital and private equity. This is why I invited the Canadian Venture Capital and Private Equity Association, or CVCA, to come on the show today. Joining us are Adriana Vega, VP of Government Affairs, and David Kornacki, Director of Data and Product. Adriana and David were both at CVCA's Invest Canada conference last month, so I'm sure they have a lot of good insight and perhaps even some anecdotes for us. Thank you so much for joining us. Okay, so we'll get to the conference, but first I gotta ask, what should our listeners know about the Canadian Venture Capital and Private Equity Association? It's a mouthful, so I think I'm gonna stick to CVCA the rest of the podcast. Adriana?
Well, thank you so much. CVCA, we represent investors in private capital industry. So this covers venture capital, of course, and private equity funds. These are fund managers who they themselves have to go fundraise, manage a fund, and allocate these dollars into Canadian companies. On the venture side, startups very much focused on innovation. While in private equity, we see a very broad diversification of their investments. And what I find very interesting is that in Canada, the majority of the deals in private equity actually go to SMEs. So succession planning plays a big role for us. And, investment plays a big role in many of the issues that we're seeing in Canada, from productivity, scalability, growth, talent attraction. And so we think that this is an important time for us to advocate and represent our industry.
And this is exactly why we're doing a podcast on this topic, because you're right, it's a good time to talk about VC, AP, and capital more generally. So as I mentioned, you were both at the big annual conference recently. It was in Calgary, I believe. So I'm curious, what were people talking about? What were kind of the key takeaways? David?
Yeah, thanks so much. It's definitely, you mentioned it in the introduction, just overall, I think Trump was the main topic, and then there was a lot of subtopics that fell from there. Just overall, the impact of tariffs across their portfolio, across the pipeline of companies coming to become investing, just fundraising in the market that we currently have now with all of the trade uncertainty. We're looking at the foreign investment is particularly from U.S. investors across the landscape. We can talk about it later on in the podcast, but just overall, what will it mean when we had so much relation with the U.S. and U.S. investors investing in these larger stage rounds on the VC side? But then there was also some investors and some conversations that they were really positive, and they were very optimistic that this could actually be a really big thing for Canada and overall the private equity and the venture capital landscape in Canada and the portfolio companies. So there was a lot of topics. But a lot of them are stemming from Trump and tariffs and trade economic uncertainty. It's really top of mind for all of us Canadians, I would say.
That's for sure. Adriana, what did you hear at the conference?
I would agree. I think we maybe called it towards the end of last year, David, when we were thinking, the theme for 25 is probably going to be business uncertainty, and it's very real for everybody. I think that that's what we hear. A little bit of a slowdown in deal making, a little bit of a slowdown in fundraising. And unfortunately, this is just the environment that we're in, right? And if you look at the cycle of our industry coming out of the COVID crisis, I think the expectation was that 25 was going to be a year of more liquidity. Unfortunately, I don't think we're seeing that dynamic again as a result of all of the uncertainty. But I will say, our sector is high risk. I think it's inherent in our industry. This is where investors go. And there is also a sense of optimism, perhaps, that when the market is low, that's almost the best time to invest, right? Because it tells you that a lot of the companies it's going to be a vintage of companies that is very resilient and very efficient. So a bit of mixed views, but absolutely uncertainty is the name of the game right now.
Yeah, and to that point, Adriana, if I can jump in as well, like there was even data presented that we saw that funds that were raised in the vintages of economic uncertainty, we're looking at, the recession, we're looking at the dot-com bust, and funds that were raised in those times, they typically were the highest performing from what we was presented, which was really interesting to look outside the box and really consider that. But then also, if you're looking at like portfolio companies that are raising right now and building products and building, just overall these companies now, they are a lot more capital efficient. They are really focusing on burn because there isn't that much capital, right? So there was a lot of sense of, oh, hey, we can actually build the next generation of really good companies and really good investors. If they can manage to fundraise successfully in this climate.
So let's keep talking about data. CVCA released last month its Q1 venture capital and private equity market overviews. So what are some of the key trends you're seeing in the data, David?
Yeah, and that's a great segue, Sebastian. So on the VC side, it's really the main speaking point that we had from all of the media covering our quarterly report was a consistent decline quarter over quarter. We can go more into the granularity later, but really the headline was quarter over quarter, year over year, we're seeing a decline since 2021. 2021, for the readers who haven't seen the report, are really, we saw a big boom. We saw a lot of investment. We saw a lot of activity. We saw record numbers, huge deals. That was something that was a bit of an outlier. But since then, we've kind of seen quarter over quarter declines. Just you can kind of see on the report as well, since 2021, you just see a steady decline. But there's a lot of other spins that, or maybe like different takes and positions that our readers have taken from that. But we have seen a quarter over quarter decline on the venture capital side. On the PE side, as Adriana mentioned, we really see, succession planning and also focus on mid-market SMEs. That's still the case. Although Q1 was really skewed by this one mega deal of $14 billion. It was a recap of Garda World in Montreal. And so removing that, we see still remaining steady, focusing on the mid-market companies in the succession planning, really. But that's been a big one. On the P side as well, the one big takeaway is privatizations are on the rise, and we have seen that from last year as well. That was one, and that's continuing into Q1. So that's an interesting take as well. If we look into exits later on and just overall privatizations on the flip side, we are seeing an increase in privatizations.
And to that, I would add perhaps just a little side note is these dynamics really do reflect a lot of what's happening outside of Canada, right? So I feel like we can sometimes focus a lot on the declines happening in our market, but they very closely mirror dynamics that are happening elsewhere, right? Like from everything from the fundraising activity and the slowdown in deal making at very different stages, all the way through to this absence of IPO exits. So I think that this sends a signal that Canada is the maturity of our market and how we are behaving in line with the global trends.
Succession planning is kind of an interesting one because as an economist, obviously that's something I've seen talked about for a very long time, that you have this older cohort of entrepreneurs. And I mean, my mother was an entrepreneur and eventually she just got to a point that she wanted to retire. And what happens to those businesses, right? So that's very interesting. But you also mentioned exits. So let's talk about this a little bit more. So I read that they slowed down a little bit. So what's that dynamic and what's the implications of delayed exits? David?
Yeah, and I think this is something that you could really see. You mentioned it in the introduction. Our public markets are seesawing. The Canadian dollars is seesawing. Everything is kind of up and down with all these different announcements. And really, the exit landscape is really reflective of what we're seeing in public markets as well. We haven't seen an IPO since 2023. And that's really, the public markets. If the public markets aren't great, if a company can't receive the funding that they require, or they think, the valuation that they need for their IPO, they won't go public. They'll stay private for longer. But then on the flip side, when I mentioned the privatizations, the increase in privatizations, there's a lot of funding now in private capital as well, and companies can stay private longer. And then when it comes to overall exits as well, like we are seeing a bit of a drop. This in Q1. That was a big headline as well on the venture capital side, and that's really primarily to do with this uncertainty, right? And Adriana mentioned this isn't something that's isolated to Canada. This is something that we see, in the U.S. and we're seeing in other markets as well. But it's definitely something if the industry is uncertain and market's uncertain, and what the economic policy will be the next week is uncertain. We will see a drop in exits. People will be holding off on these acquisitions.
Excellent. So when we think about VC NP, we tend to think about the tech sector in big cities, but it's more nuanced than that. So can you tell us about VC NP activity outside of Canada's largest cities? We'll stay with you, David.
Yeah, absolutely. And I know, like, this is something that I really like to see overall. It's primarily our reports focus on, there's Toronto, Montreal, Vancouver. Now Calgary is a big one as well. It has been seen as a secondary market, and which is funny because in the conference, that was a theme was hey, Calgary is no longer a secondary market. That was some of the speakers' talking points. Those ones from Calgary, and I would agree. It's one of the leading cities, but moreover, from my years at the CVCA, I've been at the CVCA since 2017. I see a growing heat map across Canada. It's no longer just 3 provinces anymore. We saw investment activity in Manitoba. I mean, heck, one of the biggest brands that of, like Skip the Dishes, that's from Winnipeg, right? They start out in Winnipeg, but there's also, we see some activity in the Yukon as well. That was something that we saw a few years ago as well. But it's no longer focused on these hubs. Investors, they're going to invest in the companies that are a good investment regardless of where they're at anymore across Canada. And now with everything being online and everyone can work remotely, everyone can connect online, which people can argue that it's not the same sort of connection anymore, but it's no longer required to be in the same city as an investor. It helps, but it's no longer required. I think investors will be looking at investments regardless. We see it all across Canada. We see it outside of these central cities. We see, especially on the private equity side, we see very rural cities. It depends on the opportunity and the investment and the company and the founders, right? It doesn't matter about the city anymore.
And I would encourage also, listener to think about the spillover effects, right? When you see a mega deal like Clio, for example, last year, it got a lot of attention. It kind of zeroed in on the activity in Vancouver specifically, kind of skewed a lot of the numbers towards BC. But then where are these employees based? They have employees, outside of BC, and there's even jobs in Alberta, and you saw one of Alberta's ministers actually celebrating the deal because they host some of those employees in Alberta. And so I think we tend to see these things as silos, right? Like there's a deal in Ontario or a deal in Quebec, but then these companies have not just like a national business model, some of them have a global model. And if you're a VC-backed company, the likelihood is that you have a global mindset and you are global from inception. And so we really do need to think about the spillover effects in your market, how many jobs you're creating outside your, bubble, and kind of the other types of jobs that you're helping generate in the country, right? Like the legal firms that support these companies, or, the financial expertise that kind of backs these companies. I think that it really does extend far beyond just the source of the capital and where it's going.
Yeah, I think that's a really important key takeaway, especially from the perspective of economic development. So let's talk about the role of government when it comes to VCNP. Looking at the provincial level first, what are some of the major differences between how provinces stimulate investment into companies? Adriana?
Sure. Well, you see different approaches all across the country. You have, for example, Atlantic Canada, you have Nova Scotia and Brunswick, Newfoundland. They have very generous tax credits to incentivize that capital deployment within their provinces. They have I think it's like a 15 to 30% tax credit, where if an individual investor puts capital into a local company, they get that tax credit back. Then you have approaches like BC, which is also a tax credit, and that one has been in existence, I think, for over a decade or two, actually. It's been very successful. And not only do they incentivize individuals and companies to invest, they extend the benefit actually to fund structures, which would capture investors in our community. And that's really important because you stimulate not just the investment, like the act of investing locally, but also just the capital formation, right? And that really kind of takes it to the next level. Like you're pooling all these big pools of capital, you're growing the investment funds themselves. And so that just kind of grows the level of sophistication and the capacity that they have to deploy capital. A challenge of some of these incentives are that at some point you grow out of them, right? You become so successful that perhaps you kind of have to let go of your incentive. So, just food for thought on what can we do with nation building. And then aside from the tax credit side, you have approaches like Quebec, right? Quebec is very unique, and they have a different kind of approach to incentivizing capital deployment domestically. You see, for just an example, their pension funds have mandate to invest domestically, right? Like a dual mandate for returns as well as domestic investment. And so I think each province does, the policies that work best for them. They have a strategic angle. And I think my question would be, what can we do to support that and then build on top of that as a country?
So I will ask you a version of this question, since there are different approaches out there. Is there one in particular that you feel could be expanded to the rest of Canada?
Well, I mean, as CVCA, we have advocated for a national tax credit. I think that this is a natural next step, as I was saying, to build on top of the provincial incentives that we know work. And how do we know work? Because a lot of the companies and the funds themselves have, outgrown, in a sense, some of these incentives. And this is very clear in BC, where some funds that benefited from the BC tax credit, the minute they start investing in other provinces or fundraising from other provinces, they kind of have to let go of that incentive and just kind of go at it, just without the incentive, because there's no real national level. And so as we are thinking about, the conversation at the moment is very current, removing interprovincial barriers to trade. I think removing friction to capital movement is also an important component of that equation.
And Mr. Carney is a former banker, so I'm sure he's been thinking about the capital flow aspect of interprovincial trade barrier. So let's stay at the federal level. The Liberals committed during the election to recapitalizing the Venture Capital Catalyst Initiative, or VCCI, or Vicky. So could you tell us about this program and how it has worked in the past? Because this is not the first go at it. Adriana?
Sure, no, and I was going to go a little bit into the archive of the Wiki, right? Where did it come from? Well, it starts with the VCAP 2013, succeeded by the Wiki 2017, the renewed Wiki in 21, and now we have the new announcement, which is what I'm thinking about is like the Wiki 25 plus, right? And the reason I say plus is because these have a very long, period of time. The cycles are very long in our industry. So I do think that while it's announced now, I think perhaps by the point we're talking about deployment, it could be, a year or two later on. So we're very happy to see, of course. I think it goes to show the value that has been in the Wiki. But I think ultimately the big question is, is investing in the sector a strategic priority for Canada, yes or no? And I would say, all the data shows across the world, yes, that this is a strategic imperative. If you want to be an economy that leads in technology, that leads in IP, if you want to be a player in the knowledge economy today, venture is a very crucial part of that equation. We've seen this across markets, Germany, Australia, Korea, Singapore, Israel, and of course the big one, the United States, right? Like this is what gets you that risk appetite to go into the corners that others perhaps don't go. So from that perspective, the Vicky recapitalization is great. I think that we still have some, gaps in information as to where, how this is going to happen, where it's going to happen. But by all measures, if I think, what is the role of government in this space and in, technology is I think, you're meant to de-risk this investment. You're meant to attract private capital into the space. And by far, the VCAP and the Vicky have been, great measures of success. They have achieved on both fronts. They have de-risked private capital. They have attracted private capital. And even though we're still, we're not fully exited from the VCAP because again, long periods of time. But that goal has been achieved. And not only that, but the Crown actually makes a return from these investments. So this is public-private cooperation at its best, I would say.
It strikes me that you mentioned it started in 2013, so it means both the conservatives and the liberals have recapitalized this initiative, which is interesting. So, do you think there are any tweaks that they should make to the program as they get ready to pour more money into it?
Well, I mean, if you look at the track record, each program has been tweaked slightly, right? Like they have allocated to a very, like a strategic sector. If there's a political mandate to go somewhere or to direct this capital in different directions, there's always a fund the funds, element to these programs, and then there's kind of different sort of sectoral approaches to them as well. I would say for now, what I would encourage policymakers to think about is that, timing matters, the market dynamics matter, and the ultimate goal matters as well, right? So what is it that we're trying to achieve? I think for now, the stage that we're at in this market is obviously raise more capital, allocate more capital. But I do think that perhaps the biggest, goal or the biggest win for our sector would be how are we leveraging this program to tap into broader pools of capital, perhaps other pools of capital that haven't participated in the sector before, or that have been a little bit modest or shy about participating. And when I think about this is, how do we integrate institutional investors, more high net worth individuals, more corporate investors, because it's not just government. I think government acknowledges this. Government acknowledges that they play a huge role, but they don't play the only role.
So we often hear that late-stage Canadian companies struggle to raise capital, and eventually they take on American capital, or we hear stories of, they move to the Valley. So in your opinion, Adriana, is there a role for government to address this ongoing challenge?
Yes. I mean, we've done research, and David and his team have done great research around, the makeup of, Canadian, international, US syndicates and how they invest, right? And we know that at the earlier stages, below 5 million, it's mainly Canadian syndicates investing. And as you go into the 50 million plus, that equation completely inverts, and it's mainly US-led capital that is going into these companies. So, why is this happening, and why do we care? I think on the why, there's a couple of things at play. On the one hand is some of it is just doing market things, right? It's the US is a huge market. There's a lot of sources of capital. It's very, risk-taking. And so when you have that huge diversity of pools of capital, it's kind of natural that as our investors start going into, bigger fundraises and bigger deals and, investing in bigger companies, they're naturally going to go to the US, or perhaps under normal circumstances, they would naturally go to the US for more capital. And so I think that will continue to happen. But the other thing that this dynamic tells me is that there is an absence of Canadian late stage, large pools of capital that is patient and that is willing to take on this risk to kind of invest over the long term in a very high risk asset class. So the role of government is then how do we make it more attractive? What is government doing to kind of reward that risk taking as opposed to perhaps safer asset classes like real estate, for example, or bonds or publicly listed equities. And so I think, if I were in the seat of, how do I make this more attractive? There's different levers that you can work, is on the one hand, maybe working alongside large institutional investors, pension plans, understanding what would appeal them or what kind of mechanism would help them be more aligned with the domestic market, or thinking about, the tax credits for different pools of investors, like high net worth individuals, angel investors. I think that each investor, they calculate risk in a different way. Each of them are motivated and incentivized in a different way. And so thinking about, where is the low-hanging fruit for each of them, that would be a good place to start for government.
David, anything to add?
I completely agree that with Adriana, there is a role for government to make these investments easier at these later stages, make it easier for our corporations also to participate. I know the U.S. has a lot of CVCs, and that's something that's kind of not. We're not at the same level as the U.S. with CVCs, corporate venture capital funds. So there has to be some sort of way that we can make this sector more attractive and also make it such that these investments are rewarded for making these risky investments, and it's rewarded for these corporations and making it actually attractive for them to invest in these large rounds to support Canadian companies, to hopefully keep them Canadian, right, for as long as we can.
And I think that's a good way to wrap it up. It definitely strikes me that during our conversation, yes, we talked a lot about uncertainty, but we also talked about how the sector is optimistic. And I love what you said about rewarding risk-taking, because it sounds like we're at a critical junction in Canada when it comes to the economy as a whole and where it's going, and also the adoption of technology and interprovincial trade barriers. So I think rewarding risk-taking is a really, really good key takeaway from this conversation, both in your industry, but I would argue across policymaking and in government more generally. So Adriana, David, thank you so much for coming on the show today. It was great to learn about the landscape in the venture capital and private equity space. Thank you so much.
Thank you.
Thanks so much for having us.
Thank you for listening to Intended Consequences. The views expressed during this podcast are not necessarily the views of StrategyCorp. All rights for this episode are reserved, and the guests on the Intended Consequences podcast might be current or past clients of StrategyCorp. To find out more about the work of the Institute and to subscribe to our newsletter, visit our website at strategycorp.com/institute, and make sure to follow us on Twitter and LinkedIn. I'm Sebastian Lebrac, and I intend to talk to you again next episode.